The Essays of Warren Buffett, Lessons for Corporate America is a widely respected compilation of Warren Buffett's annual letter to Berkshire Hathaway shareholders, curated and edited by Lawrence A. Cunningham. First published in 1997 and now available in several updated editions. This book offers a structural presentation of Buffett's timeless insight into business, investing, corporate governance, and ethical leadership. Author and structures: primary author Warren E. Buffett, editor Lawrence A. Cunningham. Nature of the book: a thematic arrangement of Buffett's shareholder letter spanning decades instead of chronological collection. The essays are grouped into topics such as governance and investing, mergers, accounting, and valuation. Edition note: the 5th edition 2020 includes the newer letters, reflect changes in markets, governance, and Buffett's evolving views. Now let us look into the core themes and insights. Number 1, value investing. Buffett emphasizes long-term investing in fundamentally strong business. He advocates buying a company at a fair price with a sustainable competitive advantage. His investment philosophy is heavily influenced by Benjamin's principle of intrinsic value and margin of safety. Number 2, corporate governance and management. Buffett is highly critical of poor governance companies and excessive executive compensation. He praises managers who think like owners and maintain capital discipline. His letter stresses transparent communication, accountability, and capital allocation discipline. Number 3, capital allocation. A major Buffett insight is the CEO's role as a capital allocator, deciding between reinvestment, acquisition, dividends, and buybacks. He insists that poor capital allocation decision can destroy shareholders' value even in strong businesses. Number 4, accounting and financial reporting. Buffett warns against misleading accounting practices, highlights the danger of earning manipulation and complex financial instruments. He prefers owner's earning over reported net worth, arguing it gives a better picture of company's financial health. Number 5, mergers and acquisition. Buffett critiques the irrationality of many mergers and acquisition, especially those driven by ego, flawed synergy assumption. His approach is buying a business, not a stock, seeking enduring value rather than short-term market gains. Number 6, market behavior. His classic contrarian tone, Buffett reminds readers that markets are often irrational. He warns against herd behavior and advocates calm. Independent judgment. His famous advice: be fearful when others are greedy, and greedy when others are fearful. Number 7, ethics and shareholders alignment. Buffett strongly believes in ethical business conduct, long-term value creation, and aligning management with shareholders' interest. He and Charlie Munger exemplifies these values at Berkshire Hathaway by keeping their own compensation modest and investing heavily in the company. Style and accessibility. Buffett's write with clarity, wit, and humility. Despite the complexity of topics like accounting and mergers, the tone is conversational, often humorous, and rich with analogies. The book serves as an investment primer and a business philosophy guide accessible to students, investors, and professionals. Significance in business literature. Recognized as a modern-day classic on investing and business strategy, often included in MBA, corporate governance, and finance curricula. Highly recommended by business leaders, economists and academicians for its clarity and real world wisdom. Quotes to remember. Number 1. Our favorite holding period is forever. Price is what you pay, value is what you get. It's far better to buy a wonderful company at a fair price than fair company at a wonderful price. A risk comes from not knowing what you are doing. The Essays of Warren Buffett is not just a book of investing, but a comprehensive guide to think like a rational, ethical, and disciplined investor and manager. It blends timeless wisdom with practical advice, making it an essential read for anyone interested in long-term business success, shareholders' value, and intelligent decision making. Detailed summary of Essays of Warren Buffett, Lessons for Corporate America, author Warren E. Buffett, editor Lawrence A. Cunningham, latest edition, 5th edition 2020. Overview. The Essays of Warren Buffett is a curated collection of Warren Buffett's annual letter to shareholder Berkshire Hathaway. Arranged thematically by Lawrence Cunningham, the book distills Buffett's unique principled approach to investing, corporate governance, and capital management. It serves as both business philosophy text and as an investment manual rooted in long-term value, transparency, and ethics. Rather than offering a chronological listing of shareholders' letter, this book thematically organizes Buffett's thoughts under major business and financial principles, showcasing how his worldview has shaped the success of Berkshire Hathaway and influenced global investing. Detailed chapter-wise thematical summary. Number 1. Corporate governance. Buffett advocates for a model where managers act like owners. He emphasizes that board members should be vigilant stewards, not ceremonial overseers. Executive compensation must be tied to long-term performance, not short-term stock prices. He denounces practices like opinion mania and golden parachutes. Shareholders' interest should be paramount, especially when manager considers mergers, acquisition, or reconstructing. Number 2. Corporate finance and capital allocation. Buffett explains that CEOs should think like capital allocators first, not just operational managers, weighing opportunities, cost when reinvesting profits or making acquisition. Choose repurchases, dividends, reinvest, or acquisition based on intrinsic value, not market hype. Avoid borrowing excessively, even in low interest environments. He stresses that intelligent capital allocation is cornerstone of long-term shareholders' value. Number 3. Investment philosophy. At the heart of Buffett's investment philosophy are intrinsic value, the present value of future expected cash flows, and margin of safety. Buying security at a significant discounted intrinsic value. Economists most sustainable competitive advantage that protect companies from competition. Buffett opposes short-term speculation, promoting a buy and hold strategy, and the value investing principles of Benjamin Graham. Key quote: lethargy bordering a sloth remaining cornerstone of our investment style. Number 4. Mergers and acquisition. Buffett offers critical analysis of merger and acquisition practices. Acquisition often destroys value when driven by ego or flawed synergy arguments. He warns against institutional imperative, the tendency of company to spend retained earning wastefully. He promotes buying entire business or large stakes in outstanding companies with consistent earning and capable management. Number 5. Accounting and reporting. Buffett critiques earning manipulation, calling out companies that disguises poor performance, over reliance on EBITDA, earning before interest, tax, depreciation and amortization, and non-GAAP measures. He promotes owner's earning as more accurate reflection of financial health, calculated as net income plus depreciation minus capital expenditure minus working capital. Increases his advocates transparency, conservative accounting and importance of understanding cash flows over accounting practices. Number 6. Common stock and market behaviors. Buffett believes the stock market is a voting machine in short term and weighing machine in the long term. He encourages readers to ignore market noise, resisting trend and focus on fundamentals. He critiques short-termism and quarterly earning obsessions. Advises buying stock with the same diligence one would apply when buying a business. Key quote: if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Number 7. Berkshire Hathaway. Principles and operations. The essays reveals Buffett's management approach at Berkshire is decentralized. He empowers managers to run their subsidiaries independently. He avoids bureaucracy, promotes trust and hires people he respects. Berkshire rarely sells the business it acquires. It operates under a permanent ownership model. Number 8. Taxation and regulation. Buffett candidly discusses corporate tax policies and his support for fair taxation. He argues for tax policies that do not incentivize short-term speculation or disproportionately benefited the ultra-wealthy. At times, he directly critiques policies and favors financiers over productivity capital allocators. Number 9. Personal and ethical reflections. Buffett stresses simplicity, integrity and humility in decision making. Reputation as the most important asset in business. Long-term trust over short-term profit. He critiques greed, dishonesty and herd mentality that fuels bubbles. Buffett's enduring lessons. Number 1. Invest in what you understand. Number 2. Stick to a consistency, rational framework. Number 3. Trust honesty, capable managers. Number 4. Be contrarian but only with conviction. Number 5. Focus on intrinsic value and not on market sentiment. Number 6. Avoid unnecessary complexity, especially in finance. Why this book matters? A cornerstone of modern investment literature, it's used in business schools, boardrooms and investment circles globally. It represents a synthesis of financial wisdom and ethical capitalism, showing how patience, prudence and principle-driven investment can yield success. It's not just about making money, it's about creating sustainability, ethical wealth over a lifetime. The essays of Warren Buffett is not merely a guide to stock markets or corporate behavior. It is a manifesto for principled capitalism. Buffett's idea on stewardship, accountability, value and trust are applicable far beyond investment. The book remains a timeless resource for investors, entrepreneurs, corporate leaders and students of business. The chapter-wise summary of the essays of Warren Buffett, Lessons for Corporate America, is organized according to thematic structure developed by editor Lawrence A. Cunningham. Rather than a traditional narrative format, the book is arranged into chapters, and reflect key business and investment principles drawn from Buffett's letter to shareholders. Number 1. Corporate governance. Focus. The responsibility of boards and management to shareholders. Key insights. Directors should act as owners and protect of shareholders' value. Critics. The rubber stamp nature of many boards. Emphasize accountability, independency, and ethical conduct. Calls for better alignment of CEO in intensivizing with long-term performance. Number 2, finance and investing. Focus. Buffett's foundational philosophy on investing. Key insights. Advocates value investing. Buy companies below intrinsic value. Warns against speculation and market timing. Differentiate price versus value and insist on margin of safety. Emphasizes business fundamentals over market fluctuations. Number 3, investment alternatives. Focus. Evaluation of different asset class. Key insights. Prefers productive assets, business, farms, real estate over non-productive ones like gold. Critics. Derivative and complex financial instruments. Highlights the risk of leveraging and encouraging investment in what one understands. Number 4, common stocks. Focus stocks as ownership interest in businesses. Key insights. Treat stock as pieces of a business, not betting chips. Prefers business with consistent earning, strong brand, and competent management. Encourages long-term holding and independent thinking. Reflects the need for diversification if one understands the investment. Mergers and acquisitions. Focus rational capital deployment during mergers and acquisition. Key insights. Criticizes deals done for ego or empire building. Prices acquisition based on intrinsic value, not financial engineering. Warns against synergy illusions and overpaying for growth. Stresses Berkshire preferences for friendly takeovers of high quality businesses. Number 6, valuation and accounting. Focus. Meaningful financial reporting and analysis. Key insights. Opposes misleading accounting tricks. Example, EBITDA. Focus. Pro forma earnings. Recommends owners' earnings. Net income adjusted for capex and working capital needs. Values conservative, honest financial disclosure. Believes accounting should reflect economic reality, not artificial optimism. Number 7, accounting shenanigans. Focus danger of creative accounting. Key insights. Warns against aggressive revenue recognition, off-balance sheet liabilities, and stock option abuse. Emphasizes need for GAAP adherence but not at the cost of clarity. Urges investors to go beyond reported numbers and understand the business. Berkshire at 50 and beyond. Focus. The evaluation and structure of Berkshire Hathaway. Key insights. Discusses Berkshire decentralized model with autonomous subsidiaries. Highlights the firm culture of trust, integrity, and minimal bureaucracy. Explains why Berkshire avoids dividends in favor of reinvesting in high return opportunities. Number 9, alternatives to common stocks. Focus. Non-stock instruments such as bonds and golds. Key insights. Buffett's disfavors fixed income securities due to inflation risk. Sees gold and commodities as non-productive assets with no intrinsic yield. Encourages long-term investment in productive businesses. Number 10, taxation. Focus. Corporate and personal tax policies. Key insights. Opposes tax structures that favors speculation or disproportionately benefit the wealthy. Advocates for fair, transparent taxation, including higher taxes on ultra-rich like himself. Discusses on how policies influence investment behavior. Buffett's investment principle focus. Summary for Buffett's investment criteria and habits. Key insights. Looks for business with predictive earnings, high ROE and low debt. Value strong management and durable competitive advantage. Prefers to invest in business he can understand, rejecting tech stocks in early years due to complexity. Number 12. Executive compensation. Focuses aligning pay with performance. Key insights. Critical of excessive and performance agnostic pay packages. Advocates for pay for performance systematic tied to long-term results. Calls out option mania and dilution of shareholders' equity. Number 13. Share repurchases and dividends. Focus rational returns of capital to shareholders. Key insights. Supports share repurchases when stock trades below intrinsic value. Sees dividends as appropriate if no better use of capital exists. Emphasizes capital allocation based on value maximization. Number 14. The market and investor psychology. Focus behavioral finance and investors discipline. Key insights. Caution against emotional investing, especially during market bubbles. Praises temperament, patience and rational thinking as critical investor traits. Encourages ignoring crowd behavior and focus on individual convictions. Final takeaway. Each chapter of the essays of Warren Buffett provides a cohesive and practical framework for understanding of business success for a long-term, ethical and value-driven perspective. Buffett's candid, foxy writing style coupled with profound financial wisdom makes it one of the most important texts in modern financial and corporate education. Quote compilation reflects a central tenet of Buffett's investment and business philosophy, followed by a critical interpretation and its practical implication. Number 1. Price is what you pay, value is what you get. Analysis. This quote is cornerstone of Buffett's value investing philosophy. It underscores the distinction between the market price of an asset and its intrinsic value. While price fluctuates daily basis on market sentiments, value is based on business fundamentals and earning power. Implications. Investors must learn to look beyond the price tags and assess the true worth of an investment based on long-term cash flows and business quality. It encourages rational fundamental based investing. Number 2. Our favorite holding period is forever. Analysis. This reflects Buffett's commitment to long-term investment in quality companies. He seeks businesses with enduring competitive advantage and capable management, making contrast buying and selling unnecessary. Implication. Investors should aim for low turnover portfolios focusing on compounding growth over time. This quote discourages short-term speculation and emphasizes patience. Number 3. Risk comes from not knowing what you are doing. Analysis. Contrary to the traditional financial definition of risk volatility, Buffett defines risk as a lack of understanding or ignorance. His philosophy prioritizes clarity, knowledge, and competitive over diversification for its own sake. Implication. The quote emphasizes the need for deep analysis and knowledge before investing. It also promotes Circle of competency thinking. Only invest in business you thoroughly understand. Number 4. Only when the tide goes out do you discover who is being swimming naked. Analysis. This metaphor describes how market turndowns expose poor business practices and weak financial positions. When credit is cheap or market is blooming, flaws are hidden, but crisis reveals the truth. Implication. The quote advocates conservative financial management, adequate liquidity, and ethical governance, preparing for lend times when others falter. Number 5. It's far better to buy a wonderful company at a fair price than a company at a wonderful price. Analysis. Buffett evolved from Ben Graham's strict bargaining hunting approach to a more quality focused investment strategy. He values business durability and return on capital over mere discount to books metrics. Implication. Prioritizes business quality and sustainable advantage over low valuation metrics alone. Focus on long-term potential rather than just price. Number 6. The business school reward difficult complex behavior more than simple behavior, but simple behavior is more effective. Analysis. Buffett critiques the over intellectualization of finance in academic settings. He believes many important investment principles are simple but not easy, requiring discipline, not complexity. Implication. Investors should seek clarity, simplicity, and discipline in their strategies instead of choosing complex financial engineering or historic formulas. Number 7. Wide diversification is only required when investors do not understand what they are doing. Analysis. Buffett sees excessive diversification as a hedge against ignorance. For informed investors, concentrate position is a few outstanding business are preferable. Implication. This quote encourages thoughtful stock selection and conviction investing rather than index mimicry or diversification. Number 8. In business world, the rear view mirror is always clearer than the windshield. Analysis. Here, Buffett acknowledges the difficulty of forecasting while emphasizing the past data, though clearly does not guarantee future outcomes. Implications. While historic performance is useful, investors must account for change and uncertainty and forward-looking analysis. Number 9. You only find out who is loyal when things go against you. Analysis. This quote applicable to both business partners and company culture, emphasizing the value of loyalty, integrity, and long-term thinking during adversity. Implication. During market corrections or business crisis, the strength of leadership and alignment of values becomes most visible and impactful. Number 10. The most important thing to do if you find yourself in a hole is to stop digging. Analysis. A classic Buffettism that warns against escalating commitment to a failing course of action. Its lessons in humility and pragmatism. Implication. Investors and managers should recognize poor decisions early and course correction without ego. Avoid throwing good money after bad. This quote encapsulates Buffett's consistency message. Invest in good business, act with rationality and discipline, focus on long term, and never compromise on integrity. His aphorisms are not just financial advice but principles for life and leadership.